Here's the math on the old age security clawback. On $100,000 of income in 2025, the government's own example charges about $82 a month. By the end, you'll know exactly where that tax begins and where the pension hits zero. Most people watching already know the basics of who qualifies for old age security and when. Far fewer know the pension itself is subject to a separate tax based on income, one that can shrink the payment or take all of it. That gap is common enough to be the reason this video exists. It is not a criticism. Eligibility gets more airtime, the recovery tax gets less. That separate tax, the Old Age Security Recovery Tax, lives in its own part of the Income Tax Act, and it charges an individual whose adjusted income for the year clears a threshold amount, using a formula the Act writes out in full. Before that formula, though, notice what the recovery tax quietly assumes: a single, settled full pension to measure against. That is not quite right, and the reason why is worth seeing first. Since July of 2022, anyone 75 or older receives a permanent 10% increase over the same full pension calculated for someone 65 to 74. That is not a temporary boost. It is built into how the maximum is calculated from that birthday forward. So the full OAS pension is really two numbers, and both of them matter to what comes later, because the recovery tax measures against whichever one applies to you. Here are both, for the quarter actually in force right now. For July to September 2026, the maximum monthly payment for someone 65 to 74 is up to $751.97. For someone 75 and older, on the same rules with that permanent top-up already inside it, it is up to $827.17. One line and one rate are about to apply to everyone, but where the pension finally reaches zero depends on which of those two you started from, so keep your age band in mind. Those maximums are not frozen either. By law, the full old age security pension is reviewed 4 times a year, against changes in the Consumer Price Index. And the same law puts a floor under every one of those reviews. A quarterly adjustment can never bring the payment down, it can only hold steady or rise. So the two numbers you just heard are a floor for this quarter, not a ceiling that might slip. The current quarter shows that rule at work rather than sitting on paper. For July to September 2026, the increase was 1.2%. And over the past year, from July 2025 to July 2026, benefits went up by 2.3%. If you want the mechanics explained this way, the government's own numbers on screen, and nothing else, subscribing tells me to keep making these. That's the whole ask. Now the tax itself, in the government's own words rather than a rounded-off summary. The Act charges an individual a tax equal to 15% of the amount, if any, by which their adjusted income for the year exceeds $50,000. Sit with that for a second, $50,000. Not the $93,454 you may have seen quoted elsewhere. $50,000 is the actual number Parliament wrote into the statute. So how does $50,000 turn into $93,454? A separate section of the same Act requires every dollar figure inside this part to be adjusted every single year, rather than sitting still until a future government rewrites it. Apply that adjustment year after year, and the $50,000 figure written in the statute becomes the published $93,454 for the 2025 income year, the number that actually governs the recovery tax period running from July 2026 to June 2027, which is the period we are in right now. Nobody voted on $93,454. The indexing did what it always does. Here is what that produces, using the government's own published example. Picture 2025 income of $100,000, checked against that $93,454 threshold. 15% of the difference between them comes to a repayment of $981.90 for the July 2026 to June 2027 period. Change the income number and the result changes with it, the arithmetic itself never does. And the government is careful about what that example is for. In its own words, this calculation is presented for reference only and is not official. It is a clean illustration of the arithmetic, not a number anyone should copy onto their own return. That repayment is not billed once at tax time. It is deducted straight from the pension itself, spread evenly across 12 monthly payments over the year. Using that same worked example, the $981.90 becomes about $82 taken off the monthly payment, starting in July 2026. 12 smaller deductions is an easier way to feel a tax land. It is also easy to mistake for the whole story, because the amount deducted this month was never about this month's income at all. The Act defines something called the base taxation year for exactly this purpose. For a month that falls in the last 6 months of a calendar year, the base year is the tax year that ended the December before it. For a month in the first 6 months of a calendar year, the base year is the tax year that ended the December before that. Work through both halves of that definition, and one thing falls out. Every single month across one July to June recovery tax period is measured against the exact same, already completed tax year. So the deduction hitting a pension payment this month is not a judgment about this month, or even this calendar year. It is the arithmetic of a return that was filed and closed before this recovery period began. Tell me in the comments which part of this surprised you most, the $50,000 figure in the Act, or the fact that the year being taxed right now already ended. I read every one. Put the threshold and the rate side by side, and here is the entire shape of the tax. Below $93,454 of what the government's page calls net world income, for the 2025 year, nothing happens at all. Above that line, 15 cents of every additional dollar gets repaid. Hold on to that phrase, the Act itself uses a different one, and sorting that out is the last thing we do. And it runs all the way to zero, at a different income for each age band. For someone 65 to 74, the pension is fully repaid, down to nothing, at $152,062 of net world income. For someone 75 and older, on that larger, 10% higher pension from earlier, it takes $157,923 to zero it out. That is the entire arithmetic of the recovery tax, expressed as one line and one rate. One limit on those last two numbers. Both are the maximum pension case, the same full pension those monthly maximums described. That is the column the government publishes, and the one this video walks. If your pension is smaller than the maximum, those zero-out figures are not yours, and I am not going to guess at what yours would be. One more comparison, to show that the published line really does move on its own, with nobody voting on it. The $50,000 figure in the statute does not move, that is the point of it. What moves is the indexed number published on top of it. The period just before this one, July 2025 to June 2026, based on 2024 income, and now fully completed, ran on a minimum threshold of $90,997. 1 year later, that same indexing, applied to a newer tax year, produced $93,454. Same statute, same 15%, just a newer year's arithmetic running through it. No new legislation, no debate on the floor of Parliament, just the annual adjustment the Act already requires applied one more time. That is the honest answer to why the number keeps changing every year. It was built to. One more term worth being precise about. The Act itself defines the income measure for this tax as adjusted income, and it defines it as your income under Part 1, adjusted by a short, named list of amounts the statute directs you to add back or leave out. There is a third government term to add, on the page written for people filing in Canada. The repayment page names your net income before adjustments, line 23,400 on the tax return. So, 3 government pages, 3 different terms. The Act says adjusted income. The page that publishes the line says net world income. The repayment page says net income before adjustments, line 23,400. What I will not tell you is whether those 3 land on the identical figure on your own return. No page I could open says they do, and I am not going to say it on the government's behalf. If you are filing in Canada, the page written for you points at exactly one line, and that is the line to go and look at. So, all of it in one place. A separate tax, written into its own part of the Income Tax Act on top of the pension itself. 15 cents repaid on every dollar above the line. For the year now governing, that line sits at $93,454. It zeroes the pension out entirely at $152,062 for someone 65 to 74, and at $157,923 for someone 75 and older. And the year actually being measured right now already closed before this month began. None of that is a verdict on old age security, and none of it is a plan to act on. It is simply what the government's own numbers say happens once income for the applicable tax year crosses the line. Tell me what to run the numbers on next, leave it in the comments. Like the video if it earned it, subscribe if you want the next one, and thanks for watching. This video is education, not financial, tax, or legal advice. Everyone's situation is different, so talk to a licensed professional before making decisions.